A guide to investing your first $1,000 in 2022. Who has become the fastest self-made millionaire in history? While Warren Buffett needed 55 years to reach the billionaire status, Jay Walker did so in less than a year. During the dot-com bubble, he established Priceline.com, and his net worth skyrocketed from zero to billions. But it wasn't sustainable since when the bubble burst, so did his net worth. But Buffett remains at the top of the list and doesn't appear to be going anywhere anytime soon. That's the kind of wealth you want to make. Money is a difficult game. It's taught, competitive, and merciless. And you're condemned to fail if you don't know the rules. Most people have the dilemma of working hard their entire lives but end up destitute at the end because they don't know how to make their money make even more money. To put it another way, they have no idea how to invest. Assume you've been putting money aside and now have $1,000 in your bank account. That is a remarkable performance considering that over 70% of Americans do not even have $1,000 in their bank account. Let's imagine you're going to invest that money instead of wasting it on another useless device or a pair of shoes that you'll wear once and then keep in your closet for years before finally throwing it away. But how do you put your first $1,000 to work for you? Do you put it in the stock market or in real estate? What types of stocks do you invest in? Is $1,000 even sufficient to begin investing? All of these questions and many more will be answered. So, give this video a thumbs up and let's get the ball rolling. Consider this example to better understand what investing is and how it works. If you worked hard to save $300,000, you could go to a Ferrari dealership and buy a luxury vehicle to show everyone how successful you are. Or you could buy real estate, like a house, and rent it out. At least $2,000 will be paid to you every month. You can sell it and regain your initial investment if you decide you no longer want to get that $2,000 paycheck every month. Indeed, the value of your investment may increase, allowing you to sell it for a bigger profit. And that is how money generates money. However, $1,000 will not buy you a real estate. That isn't even enough for a down payment. But that doesn't mean you can't put that money to work elsewhere and expand it. The simplest solution is to put it in a savings account and earn interest. But why should the bank pay you to keep your money in the bank? Shouldn't they charge you instead? No. The bank will take your money and lend it to someone else at a higher rate, and a portion of the profit will be shared to you. In a nutshell, this is how banks operate. The only issue with this method is that the interest rate on the deposit account is so low that it isn't worth it. The best rate you'll likely get is 0.8%. This means that if you put $1,000 into a savings account now, you will receive an additional $8 in 12 months, which is exceptionally low because the Fed aims for a 2 to 3% inflation rate, which implies that if you don't get at least 2 or 3%, the real value of your $1,000 will degrade over time, allowing you to buy less items each year. But why are deposit account interest rates so low? Because interest rates are low this year as a result of the pandemic. The Fed has been compelled to cut them to encourage everyone to borrow and spend. When we get out of this crisis in a year or two, the Fed will raise interest rates to 1, 2, or possibly 3%, which means savings account interest rates will climb as well. The second choice is to purchase government bonds. A government bond is a government-issued asset that is used to raise funds for government spending. If the government wants to build a school but doesn't have the funds, it can issue an IOU, a piece of paper that states that the US government owes the owner of this security this much money plus interest. Of course, this is an oversimplification, but it proves the point. Because interest rates are exceptionally low this year, Government bond rates are less than 1%. But when interest rates were high 2 years ago, government bond rates were as high as 3%, which is not bad because government bonds are the safest investments you can make. Any investment has some level of risk. For example, what are the possibilities that the US government would default on its loan? The entire US economy may have to crumble in order for the US government to go bankrupt. As a result, US bonds are regarded as the safest investment on the planet. However, if you want a bigger return, such as 10%, 20%, or 30%, you might consider investing in the stock market. For example, Amazon's stock price has surged by more than 80% this year alone. Google's stock price increased by about 30%. The stock of Tesla has grown by 721%. Yes, you heard that right. 721%. Why would anyone invest anywhere else when they can double or even triple their money on the stock market? Risk is the answer. There isn't much risk when it comes to government bonds, for example. In fact, it is risk-free to a certain extent. But when it comes to individual companies, there is a risk that the company might fail. It might report negative earnings. Pretty much any negative news can drive the stock price down. The company might release a product, and if the public doesn't like it, that can make some negative headlines, which can drive the price down. So with higher returns comes more risk. Apple is a well-established company and its chances to fail are way lower than Tesla, but it also has less room to grow than Tesla. That's why Tesla grew by 721% this year, but Apple by just 70%. You must decide for yourself how much risk you can tolerate without going insane. If that $1,000 is all you have left, perhaps risking it all isn't the best idea because if things go wrong, you could lose the majority of it. Investing in an index is one approach for investors to reduce their risk in the stock market. The most well-known is the S&P 500, which tracks the top 500 US corporations. An index fund would essentially invest in these corporations. Some of these businesses will undoubtedly fail, while others will thrive. According to historical data, the S&P 500's average return rate during the 1920s has been roughly 10%. This means that investing in these index funds entails owning a small piece of the top 500 US corporations. VOO, or Vanguard 500 Index Fund, QQQ, or Invesco Index Fund, and Fidelity Zero Total Market Index Fund are my 3 favorite index funds. They're all fantastic and invest in nearly identical businesses. But how do you go about purchasing index fund shares? Where do you even begin? To get started, you must locate a broker who is qualified to sell you stocks. It was always someone in the past. You had to pick up the phone and contact him to ask him to sell you some shares. Remember the Wolf of Wall Street? He would call individuals all day long and try to sell them worthless investments. But thank God, we've arrived in 2020 when things are much better and simpler. Brokerage firms such as Robinhood, Webull, and others have developed apps that allow you to buy stocks from the comfort of your smartphone. You can start investing right immediately after downloading one of these apps and signing up. I attempted to make this video as simple as possible so that anyone interested in investing can get started right away. Often, you want to start investing but have a million questions. So you start Googling this and that and eventually become exhausted. So you give up and try again a few months later. In this short video, I attempted to address all of your concerns. So if you found the video useful, please give it a thumbs up. And if you're new here, please subscribe and click the bell beside it. Thank you for watching, and see you again soon.